partnership audit rules effective next year. Today's program will be presented by Marcus Dyer, a tax manager at Withum Smith & Brown, and Tom Fleming, a principal here also at Withum Smith & Brown. Before I begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also at the bottom of the toolbar, you will see a chat box. Feel free to send us any questions that you have during the presentation, and we will do our best to address them. If we don't have time, we will shoot you a private email with your questions because we are seeing them. There are going to be 4 polling questions throughout the program, and to qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it so we can provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Marcus and Tom.
Good afternoon, folks, and thank you for joining us for our presentation on the IRS's new partnership rules. My name is Tom Fleming. As Brooke mentioned, I am a principal who specializes in taxation for Withum, and we're going to spend the next hour talking about this matter that, frankly, I think is extremely complicated, and I'm not sure that the tax controversy community is ready for this yet. But what we're going to do is spend an hour, like I said, and hopefully we can shed some light on this and clarify some matters that may be causing some confusion, as well as maybe shed light on some other items that, frankly, not many people may be aware of at this point. What do you think, Marcus? Go ahead.
Agreed. Thank you, Tom. As Tom said, my name is Marcus Dyer, and I am one of the leaders of Withum's Tax Controversy Group. And prior to entering into the public accounting industry, I practiced law for a number of years. My background is in corporate tax and tax litigation. And as Tom said, we're going to spend about an hour with you here today tackling a complex area of the tax code that is going to affect many of us, and some of us surprisingly. And these rules and regulations are very new, so we're pouring through them. We don't have any, unfortunately, we can't tell you that we have experience in working through these rules because they don't come into effect until obviously January 1, 2018. So we have lots of examples for you, and we're going to just get through this material together, and hopefully we'll all learn from each other.
So I think, Marcus, we should probably start. I know this may be rudimentary or maybe pointing out the obvious, but maybe we should just start and talk a little bit about the fundamentals of a partnership and how that works as relates to other types of entities, because I think that does play a part into the whole intent of the IRS and Congress.
It does. Couldn't agree with you more, Tom. To understand the new partnership audit rules, or the BBA, we'll sometimes refer to these rules as. We must first understand the whole concept of the partnership. So we'll just go through this. I know this is going to be something that most of you are familiar with, but as a refresher, a partnership is a type of business organization in which 2 or more individuals pool money, skills, talent, and other resources and share the profit and the loss in accordance with the terms of a partnership agreement. And as we know, partnership agreement does not necessarily, does partnership agreement have to be in writing?
No.
No, not really.
It does not.
But there is an agreement, right?
I think if you put your lawyer hat on, you would tell every person or every partnership that it does have to be in writing, but theoretically, legally, it does not have to, right?
That's exactly right, and you should have one. And okay, so in the absence of a partnership agreement, partnership is assumed to the partnerships are assumed to share equally in the profits and losses and the risks and rewards. Partnership is best viewed not as a separate taxpayer or even economic entity, but rather as an accounting device to determine the proper amount distributable, to each partner. How much money does each partner get, or property, whatever the partnership is going to distribute out, and how much, and as corollary, how much each partner is going to wind up with in tax. And we use special accounting rules for partnerships, the capital accounting rules, which are beyond the scope of this discussion. But the key thing to remember is that with a partnership, the income is not taxed at the partnership level. The income is passed through and taxed at the individual taxpayer level. Okay, next slide. How are partnerships currently audited? Okay, before launching into the new rules, the BBA, let's just take a minute to take into consideration how partnerships are currently audited. This is something most people don't know because you probably haven't experienced. We're going to go over, we're going to explain why that is the case here in a minute. So under current law, we have the Tax Equity and Fiscal Responsibility Act of 1982 in effect. That's otherwise known as TEFRA. Under TEFRA, the tax is determined at the entity level. So unlike with a partnership where there's no tax paid at the partnership level, as I said before, the tax under TEFRA, when the IRS audited a partnership, the IRS would determine that tax at the entity level. But then the partners were assessed individually based on the partner's allocable share of partnership adjustments, income and adjustments, the amount of tax. The IRS would interact with what was known as a tax matters partner. And so you can probably already imagine the difficulties that the TEFRA entails. So the IRS makes a tax determination at the entity level, and then it has to pass that tax out to the partnerships, which can be numerous, and chase them all down. So let's talk a little bit about what that process entails. Under TEFRA, if you had 2 or fewer partners, audits are at the partner level, much as was the case pre-TEFRA. If you had 10 to 99 partners, the TEFRA procedures applied, the ones that I just discussed. If you had 100 or more partners, then the TEFRA rules applied unless the partnership is one of very few that opted into a regime that's very much like the BBA that we're going to be talking about shortly. So there's 3 tiers here, under TEFRA, and they were cumbersome.
I think the bottom line is more to the story is TEFRA never really took off. It's been around for a long time, as you can tell, since 1982. Right. And I've seen a handful of TEFRA audits. So it's not like the IRS, frankly, the IRS did not embrace that legislation. They pretty much steered clear of it. Right. Yeah, there were so many problems implementing TEFRA, which takes us to our next slide. But just one thing before you get into that, if our audience is anything like me, they like to know what their acronyms mean. So BBA actually stands for Bipartisan Budget Act of 2015. Right. Yeah. So this has been something that's been in the hopper or been in the works since 2015. We're at a point right now where, as you mentioned previously, that it's effective tax years after 2017. So it took a few years to get this thing moving. And frankly, at this point, it's developed, but nobody really knows how it's all going to play out. We could be dealing with another TEFRA here potentially. Yeah, we could be, and what Thomas is speaking to here is the complexity of the BBA, and so what the Congress did, recognizing that this would be very complicated to implement. The Congress built in essentially a 2 or 3 year lead time
And so it was enacted, I believe, November 2nd of 2015, and to be effective January 1, for tax years January 1, 2018, partnerships could opt in. I can't imagine. I don't think there are very many.
I'm not familiar with
that were opting in. I think the
Right.
PATH Act, there's some legislation that allowed them to opt
Yeah.
opt in, but all that time has been taken to issue and reissue Treasury regulations that are required to answer a lot of the questions that we're going to be talking about here shortly.
Exactly.
Okay, the reasons for the change. What is the need for the new partnership audit rules? Well, if you have experienced TEFRA, you probably are wondering why the changes didn't come sooner. The GAO did a study, and it found that the IRS was auditing relatively few large, complex partnerships returns. This is due mainly to the complex TEFRA partnership rules. The study uncovered that large partnerships more than tripled from 2002 to 2011. So obviously the partnerships were recognizing the low probability of their being audited. In fact, the number of partnerships in that time frame skyrocketed 47%. Within that same 2002 to 2011 time frame, the number of C Corps were down 22%. So what were the numbers in terms of auditing? Interestingly, what the data showed was that in 2012, there were only 84 field audits of the 10,143 large partnership returns, exam rate of 0.8%. Compare that with similar size C Corps with an exam rate of 27%. What's more, 66% of large partnerships audits resulted in no change. Really makes those of us in the tax controversy space look brilliant. And compare that with a no change rate of around 27% for similarly sized C corporations. And what were some of the problems with TEFRA? Well, we mentioned before, identifying the partners and collecting tax among all the partners who could be spread out, all over the world.
Yeah.
It's one of the main issues. So next, let's take an overview of the BBA. As stated earlier, the BBA was enacted on November 2nd, 2015. And the objective of the BBA was, unsurprisingly, to make it easier for the IRS. It's not to, and obviously, it's to collect tax. I mean, that's not, pretend as if that's not an ulterior motive of the IRS. And as a matter of fact, there is a revenue estimate of $9.3 billion that is predicted will be collected over the course of 10 years as a result of the BBA.
So this is striking to me when you look at this, because what you have is what you first said right out of the gate, which is, what is a partnership? A partnership is basically a group of individuals that come together and essentially they share in the assets of a single entity that holds the assets, but everyone has a share, everyone has an interest in those assets. And any income that's earned or any deductions get passed through and get reported individually. But here what we're saying, what the IRS is trying to do is create a one-stop shop for their auditing convenience, right? And say, we're not auditing the people we're not auditing the taxpayer. We're auditing the partnership.
That's exactly, and they're going one step further. While TEFRA broke new ground by shifting the focus of the partnership audit to the partnership level, the partnership audit to the partnership level, the BBA goes one step further. It provides that the tax on any adjustment that results from a partnership audit shall be assessed and collected from the partnership.
Right. So you're almost, you're creating like a hybrid entity almost, something between a pass-through entity and a regular corporation where when it comes to auditing and audit adjustments, you're getting taxed at the entity level.
But that's exactly, very much like a corporation.
Like a corporation?
Yeah. So in that regard.
But you're not taxing it like a corporation.
Well, it's not. You're not converting it. You're not converting it to a corporate. No, not for all intents and purposes. I'm not saying going forward that partnerships are going to be taxed as corporations. Right. But if you get audited,
you're going to get taxed.
And you're subject to the BBA,
you're going to be
treated. You're going to be treated like a corporation,
which is a little bizarre.
Well, that's
but
that's the alternative was was TEFRA.
Was TEFRA, yeah.
Right. So. Okay,
what do you think about that revenue estimate of $9.3 billion?
Well, it's that's hard to say. Depends.
It is hard to say.
It's very hard to predict, and as we're going to discuss here in a minute, that depends on a lot of variables, and whether how many partnerships actually wind up being subject to that partnership level tax. So let's dig a little deeper and discuss some of the minutia of the new partnership audit procedures. Okay, as I said before, instead of having the tax pushed out to the partners, the partnership pays the tax. But there are several exceptions to that stricture. Instead of having the entity pay the tax, the BBA allows a partnership to push the liability out. It's going to push the liability out to the partners. To make a push-out election, the partnership must provide a statement to each person that was a partner in the partnership and the year under review. And we're going to go through these definitions here in a minute. That's the review year. And indicate the portion of the liability for which each such partner is responsible. And you can already see like one of the problems with the BBA. So you're determining that the partnership owes tax at the entity level, and you are auditing that partnership. Let's say in 2015, in tax year 2015, for a partnership return that was engaged in business activity, let's say back in 2012. So the partners who are being responsible for the tax when the return is audited are not necessarily the partners who receive the benefit of the pass-through income.
So that's a complete, when you think about this is a complete violation of partnership law. Right? You have a new partner coming in that's basically a profits-only partner that has no prior interest in the partnership whatsoever. His interest, any consideration that he receives, really is from that moment forward.
Right.
However, he has some potential liabilities that are out there that he may potentially have to, he'll be partially responsible for potentially.
Well, indirectly, sure. Yeah, right.
Not directly,
sure.
but indirectly.
Right, sure. I mean, that's, the partnership pays the tax, and so the owners are, indirectly the ones who are going to bear the incidence, of that tax, and that's exactly right. Yeah. That is something that partners, should factor in when they enter in these partnerships. So what one alternative is to be in a partnership where you can push that liability out. So you push it out, and then you push it out to the partners who were members, when the economic activity occurred.
Yeah.
And
I think we'll talk a little bit about later.
Sure, we will. But a couple more points that they're important to know, and that is that when the partnership pays the tax, understand that it's going to pay it at the highest tax rate under Section 1 or Section 11 of the Internal Revenue Code. Section 1 is for individual income tax rates, I believe. And so that's at, under current law, the top rate is, I believe, 39.6%. I know under the new tax reform, they're thinking about bringing that down to 38%. That's still high, either way. So that's, and so you ask, well, what if the partners are subject to lower tax rates? Well, they're bearing that incidence of the tax at a 39.6% rate. So that's something else that you have to take into consideration. And the other important point to remember about the BBA is that many partnerships can just opt out. Say, I want no part of this regime. And but you have to be a qualifying partnership. You have to have 100 or fewer partners, and your partners, must be of certain types.
Yeah. So let's just talk briefly about the tax rate. So I think what you're saying here, just so we're clear, because I think it's probably worth noting, is that in a partnership you have various types of income that you can potentially pass through. So you have your ordinary income, you have your dividends, which could be qualified dividends that are subject to tax at a lower rate, as well as capital gains that are subject to tax at a lower rate. What the IRS is doing at the partnership level under the BBA is aggregating all the tax, all the income.
That's correct.
And taxing it at a flat rate.
It's under the BBA. It's all ordinary income.
Right.
There is no such thing as capital gains.
And then,
or tax-exempt income, or even tax-exempt income.
Right.
That was your next
point. And then the next step is the onus is essentially on you, which we'll get into a little later, to say, no, you're not taxing that correctly.
That's exactly right. Unless you're just going to opt out.
Opt out. Yep.
Right. Okay. So let's take a look at an example. XYZ are equal partners in a partnership. In 2019, their partnership reports $30 of income. Let's say in 2021, the partnership reports $90 of income. The IRS comes in and audits the partnership and determines income in 2019 should have been $0. Under current law, the partners can file for refunds of $10 each on an amended 2019 return. Okay, and actually, this is one that's the opposite of being assessed, where they have the understatement. This is the
well, that happens sometimes too.
Right. So
you
this
get
is the overstatement. Right, this is overstatement. So this is going to factor in the overstatement of income. Under the BBA, the partnership would reduce its 2021 income from $90 to $60, and each partner should then be allocated only $20 of 2021 income instead of $30. Thus, the partners have overreported for 2019, and they overreport for 2019 and underreport in essence for 2021. Okay.
Okay.
Okay. Let's take a look at some of these key definitions. I think it's very important to keep a few terms in mind when you're dealing with the BBA, because remember we said earlier that the partner enters the partnership after certain business activity was engaged in that led to an examination, and it led to a determination of an understatement. So what are some of the key terms here? There's the reviewed year, and the reviewed year is the partnership tax year or the return under audit. Going back to my example from earlier, the IRS audits in the tax year 2015, but it's auditing the 2012 tax returns. The reviewed year will be the 2012 tax return. There's the adjustment year. generally the year in which the adjustment for the reviewed year becomes final under a court decision or notice of final partnership adjustment. There's the imputed underpayment amount. This is the net non-favorable adjustments to the partnership tax year multiplied by the applicable tax rate. That's the 39.6% times the amount that the IRS says the partnership is underpaid. The income of the partnership is underpaid or underreported, I guess. And then there's the partnership representative, which we're going to get into in detail a little later. And this is the person or party selected to represent the partnership before the IRS and to make decisions on behalf of the partnership.
Great. Okay. So with that, we're going to be moving into our first polling question. And you're going to have a minute to answer it. So an objective of the new partnership audit rules is A, to make it easier for the IRS to collect tax when auditing partnerships, B, to make it easier for taxpayer representatives to represent partnership clients in audits, C, to simplify the tax code for taxpayers, and D, none of the above. So I'm going to launch it, and you guys can go right ahead and start doing your votes. And just as a reminder, in order to get that CPE credit, you guys have to answer all 4 polling questions that are going to be happening from now until 2 p.m. when the webinar is over. So go right ahead. I see some of you guys are already making your decisions. Okay, you have about 10 seconds left to answer, so make sure you guys are getting those in. Okay, we are going to close that poll out and sharing our answers. So Marcus, what's the answer?
Okay, the answer is A, to make it easier for the IRS to collect tax when auditing partnerships.
Awesome, 83% of them got it right.
Very good.
What everybody's objective is to make the IRS's job nice and easy.
That's what, right. That's all of our goals.
Okay, moving on.
Okay. All right. So let's talk a little bit more about the partnership level determination. So as you recall, we were briefly speaking about a decision that you will necessarily make, with respect to whether you opt out or push the liability out. So in order to make that decision, it behooves us to talk a little bit more about what the partnership level determination makes. And by the partnership level determination, I mean allowing the IRS to assess and collect the tax at the partnership level. All right. If you allow that to happen, all partners are bound by a final determination in the partnership audit proceeding. That means the partners do not have the right to challenge that determination. They do not have the right to participate in the audit proceeding. Can't offer up information on their own behalf. They're not going to receive notices along the way. If there are penalties, here's the key point. If there are penalties, the penalties will be determined at the partnership level. So if the partner has some type of defense, that the partnership doesn't have, well, then that partner is just out of luck. And only partnership level statute of limitations applies. A big advantage to the taxpayer under TEFRA was that the clock was running on all these individual partners. So IRS had to track them all down and beat the statute of limitation with respect to all of them.
Yeah.
But now there's only one statute of limitations that need to be complied with, and that's at the partnership level.
I think that there's a lot of stuff that you need to parse through on this page right here. The first thing has to do with, or I think when I look at this, the first thing that jumps out at me is you know, what is this sort of a one-size-fits-all concept? And I think the answer is absolutely. You really need to, each partnership, and even the partners need to have a say into this is how we're going to function.
They do.
As a partnership, because, you know, the question is, will this work for every partnership? You know, not having any authority over your assessment, will that work for the partnership? Looking at, you know, the statute of limitations, I mean, that's an issue in and of itself. When you look at, there are a handful of things that extend the statute or open up a statute.
Sure.
And if you're a partner in a partnership, you may not want to be legally bound by the statute of the partnership, which theoretically you will be.
Right. That's exactly right. If you would have any reason or shorter statute, again,
that's the one that you want.
Right. You're out of luck. You're bound by that.
And by virtue of the fact that you're generally going to be looking at bigger numbers on a partnership return than on a partner's return, that in and of itself, through a calculation that's beyond the scope of this webinar, could potentially make you, could open up the statute or extend the statute for you from a 3-year statute.
It sure could. Yeah, that's exactly right. Because it's aggregated. Everything's aggregated at the partnership level, and that's right. So an understatement's a bigger understatement. So you're going to wind up with a longer statute. That's a very good point. So partners, by agreeing to allow tax assessment and collection at the partnership level, could in essence be giving the IRS in some cases more time.
Yeah, no, there's just so much. This is just so complicated when I look at this stuff that it just, unfortunately, I think what really needs to happen is every partnership needs to look at this and understand it and determine what works best for them.
Yeah, and that is why we're here. We're going to provide some of that food for thought to make that critical determination. Right? I certainly wouldn't accept it without going through the analysis. All right, so now let's talk a little bit more about the imputed underpayment. So that imputed underpayment occurs when the partnership agrees is affected by the BBA, and the partnership underreports its income, and the IRS makes that assessment at the 39.6% rate. Let's talk a little bit more about that. There is actually a relief for some partnerships. Partnerships can submit evidence to reduce this imputed underpayment by the portion that would be allocable to, let's say, tax-exempt entities. For example, you have a corporation that has tax-exempt income, or a nonprofit is a partner. Well, then you could. We'll talk a little bit more about this in a little bit, but that information could be provided at the partnership level and reduce the imputed underpayment, and partner receiving allocation, and the same would apply if, let's say, an individual or a partner was subject to capital gains. You mentioned that example earlier, Tom, or dividends. Again, you could produce evidence to reduce that imputed underpayment. Okay, how about another example? Partnership has 3 equal partners, X, Y, and Z. Partner X is also a partnership consisting of 3 tax-exempt entities. Y is a corporation taxed at the 35% level. Y is a corporation taxed at the 35% level, and Z is an individual. The IRS audits partnership XYZ resulting in a $120 increase in partnership's long-term capital gain for the audit year. If the partnership XYZ pays the tax due under the default rule at the partnership level, the tax is $47.52, which is $120 times the 39.6% rate. But what if the partnership can submit evidence to reduce the imputed underpayment? Well, the result would be Y share would be $14, $40 times 35%, right, for a corporation. Z share would be $8, $40 times 20%, and X's share would be 0. So the total burden is reduced to $22 and under that fact pattern. Okay, next let's take a look at some factors partners should consider when forming a partnership agreement, or those who already have a partnership agreement, addressing whether the partnership agreement should be amended. Tom spoke earlier about the dangers of treating the BBA, the termination at the partnership level, as from the standpoint of a one-size-fits-all philosophy. So let's talk about some things that you want to think about to determine how you should treat the different options that the DBA allows. And one thing that you should consider is whether the partnership representative should have an obligation to attempt to lower the partnership rate of tax, right? We talked earlier about how the partnership can reduce the tax from around $39 to $22. Should you have it in your partnership agreement that the partnership representative has an obligation to do that, to get the rate down to $22? If so, the partnership agreement may need to provide or contain authority in the partnership agreement for the partnership representative to request partnership-specific information, right? So if a partner is saying that he is entitled or she is entitled to a capital gains tax rate, well, the partnership representative should be able to request that information to prove as to why that lower rate is permissible. And another thing to consider, should the partnership agreement give the partnership the ability to pay tax from the partnership accounts, or should the partnership representative have a right to make a call to capital or take out a loan to pay the tax? Some additional factors that should also be taken into consideration. And if the decision is made to allow the partnership representative the authority to take the actions needed to reduce the tax, should there be any penalties that apply to folks who do not comply and allow the partnership representative to get the tax down?
Yeah, I think this, again, there's just so many things that jump out when you look at a page like this with this information that's on it. Right off the bat, this whole partnership representative thing is so complicated in and of itself. And let's think about, and this is something that's mentioned in the slide that we'll get into a little bit more later, but I think it's worth stressing. The question is and unfortunately this is so new that you don't really have much experience with what partnerships are doing, but who should a partnership representative be? And what type of obligation are you going to have with that partnership representative? Because it does not have to be a partner in the partnership. So you
Right.
can't really write something into the partnership that says the partnership, the representative must, under this agreement,
Right.
must have an obligation, because they're not bound by that agreement. Not every partner rep will potentially be bound by that partnership agreement.
Right, which is something, you certainly have to. And that begs the question whether you should have one who's not.
And then
who's not. But
right.
but if you do, then you certainly have to. That partnership representative you'd have to contract that, right? And
Exactly.
whomever you
Right.
hire, that partnership representative would need to know what the terms of that partnership agreement are, what the partners have agreed to.
And then once you have, so let's just say that you have an agreement with someone, whether it's inside the partnership or outside the partnership, does any representative really want to be bound by such open language that you have an obligation to attempt to lower the partnership rate of tax?
Well, and that's certainly something.
I mean, if that's not a can of worms, I don't know what is.
And a partnership representative probably needs legal counsel. I mean, but you certainly want to read any type of retainer, any type of retainer agreement between the partnership and a partnership representative that is not a partner of the partnership, or the partnership agreement, and that section, that provision of the partnership agreement that pertains to a partner who is a partner in the partnership. But it was a partnership representative who is a partner in the partnership.
Whether it's a partnership, a partner in the partnership or not, if you just think about the premise of you have a large partnership with 500 partners, which is common. Not every partner
Sure.
operates like that, but it's common. You have 500 partners that have some sort of potential malpractice with that representative.
It is a job that you have to be careful about before assuming.
Very careful.
Yeah. Before assuming, and
Yeah.
that if that's your point,
Yeah.
there is a lot of exposure. That's well said. Okay. And so next we're going to talk a little bit more about the imputed underpayment amount. So if you have an imputed underpayment, the partners doing the reviewed year can file amended returns, and the partners take into account their distributive share of partnership adjustments and pay the applicable tax. The partnership is allowed to reduce the imputed underpayment by the applicable tax attributable to the partners filing amended returns. Okay, so again, when you push the liability out, I'm sorry, we're still reducing, so we're still talking about reducing the underpayment. The partnership has 270 days from the date of the notice of proposed adjustment is mailed to file any documents or evidence to have the imputed underpayment reduced. So this is going back to a scenario where you're producing evidence to get the imputed underpayment down from the 39% tax rate. 270 days. The IRS must approve any modification of the imputed underpayment amount. So that's why it's important for the partnership representative to be able to obtain from the partners the information needed to satisfy the IRS. You can imagine you're going to have some very dissatisfied partners, right? And you have some allocation issues, and some partners comply and provide the information to get the imputed underpayment down. Others do not. The partnership representative is going to have to allocate this and make sure that he can, I guess, allocate the proper tax to those who provided the information, and make sure those who didn't are going to be paying at a 39% tax rate. So that's not an enviable position to be in.
And a lot of the struggles with this isn't for a small partnership or a typical small partnership. It's larger partnerships that have foreign owners,
right?
And the determination of whether someone's subject to a reduced rate, who's not subject to the reduced rate, who's complying, who's not complying, who you can get a hold of, who you can't get a hold of.
Well, and all of these were problems in the IRS in the past. And you see how they've been shifted. And so, but that's what the IRS has. You're living in their world, and that's why you had so few partnerships audited. Okay, we'll take a quick look at an example. In 2018, X and Y each own 50% of partnership XY 50/50. The partnership reports a $1 million deduction allocated 50/50. In 2020, the IRS disallows the 2018 deduction, resulting in underpayment of $396,600, $1 million times 39.6%. X files an amended return for 2018, reporting her 50% share of the partnership adjustment, and she pays her total tax, interest, and penalty of $250,000. Result, partnership's imputed underpayment is reduced to $500,000, and the partnership pays total tax, interest, and penalty of $250,000.
Okay, and we're going to be moving on to polling question number 2 now. And you guys will have a minute to answer this one as well. So the new partnership audit rules replace A, the Tax Cuts and Jobs Act of 2017, B, the Protecting Americans from Tax Hikes Act of 2015, C, the Tax Reform Act of 1986, or D, Tax Equity and Fiscal Responsibility Act of 1982. And you have about 30 seconds left. Okay, about 15 seconds left.
Good.
Okay, here we go. And what is our correct answer, Tom?
The correct answer is D.
Awesome. 83% of you guys got that right, so good job.
Wow, smart audience. Let's have a bunch of tax people in the audience. All right. What do you think?
That sounds correct to me. They are sharp. Okay. So now let's talk about the reverse, the favorable adjustment for the taxpayer, right? I mean, that sometimes happens to those of us in tax controversy, right, Tom?
That's right.
The IRS winds up owing the client.
That's right.
And so under section IRC section 6225A2, the partnership takes into account the taxpayer favorable adjustment as a decrease in non-separately stated income or an increase in non-separately stated loss. If the item is a credit, it is taken into account by the partnership as a separately stated item. The adjustment is taken into account in the adjustment year and as an adjustment to the partnership income or loss, and then flows through to the partner. So it's not being adjusted at the reviewed year, right? Not the tax return for the tax year in which the activity was engaged in, but the year the adjustment is made, the year of the examination. That's the year that the benefit is accruing to the taxpayers. Returns are not amended because the partnership is taking the item into account in the adjustment year. Okay, thus current year partners benefit from adjustment made for a prior year tax return. It's an important thing to remember. Okay, alternatives to partnership level assessment. All right, so in one case we talked about allowing the partnership to be subject to the imputed overpayment at the partnership level, 39.6%, or you can get that amount reduced, right? But another option is you can just, or you can push the liability out, right? Another option is simply to opt out. So you don't want to have you do not want to be bound by the DBA at all. Partnerships with 100 partners or less can opt out of the entity level partnership determination. Opt out is an annual election. The election must include a disclosure of the name and taxpayer identification number of each partner. Partners must be individuals, C corporations, S corporations, or states of deceased partners. No upper tier partnerships, no partnerships. S corporation shareholders must be counted for purposes of the 100 partner test and disclosed to the IRS. take a quick look at some drafting recommendations. Sorry. Okay, the partnership agreement should address, should the partnership agreement address electing out? And what are the criteria for doing it? Should the partnership agreement have the authority to elect out? If electing out is desired, should the partnership agreement provide transfer restrictions to avoid transfers that would negate the ability to elect out, right? You don't want to allow a partner to transfer a partnership interest to a partnership, and then you can't opt out. Should the partnership agreement contain a covenant to remain under 100 partners? Okay.
Okay, and we're going to move on to the next polling question, everyone. Okay, and it's launching now. So the types of entities subject to the new partnership audit rules include A, S corporations, B, C corporations, C, trusts, or D, none of the above. So make sure some of you guys are answering that. And you have about 30 seconds left. About 5 seconds left, and then we're going to close it out. Okay. And Marcus, what is our answer? Because we have a really close split.
Okay, so any subject to new partnership audit rules include none of the above.
Good, all right. So, good job. That was a 60-40 split between all of you.
Yes, corporations are trick. All right, next let's talk about the alternatives to partnership level assessment, the push-out election. Okay, we touched upon this briefly. We'll address it in a little bit more detail now. So alternative 1 is partnership level assessment and collection. Alternative 2 is accepted at the partnership level, but not a 39% rate because you prove that a lower rate is applicable. Option C is say, hey, I'm going to opt out of the whole regime entirely because I'm eligible. Option D, you can push the liability out. Okay, partnership election to issue adjusted partner statements under section 6226, the push-out election. A partnership may elect to issue adjusted statements to the partners who were partners during the reviewed year. And this is what Tom was intimating to earlier. So now you want to make sure the partners who should be affected, who got the benefits of the income or of the understatement, are now being subject to the tax. The election must be made within 45 days of receiving the IRS notice of final partnership adjustment. The partnership must then furnish statements to each partner for the reviewed year and to the IRS. The partners receiving the statements are subject to the tax and the year of the statement. Okay, and a few more things to consider. The reviewed year partners pay the interest and the penalties, right? Interest, interestingly, is charged at a higher rate. So if you push it out, and there's an underpayment, an understatement of tax, the interest is going to be 2% point higher if you push it out. The reviewed year partners have no right to an administrative or judicial review, and partners are bound by the partnership level determination. So you don't get to fight it. You want to opt out if you want to fight the partnership level determination. You pretty much have to just pay the tax, but you can push it. You can push it out. And all right, let's consider some drafting points. So one thing you want to consider is whether the push-out election should be optional or mandatory, right? And should you give the partnership representative the discretion to decide this? On the one hand, maybe she can make the best decision based on the facts and circumstances. On the other hand, you may not like the decision that she makes. Maybe good for some partners, bad for others. If optional, what are some of the principles for deciding when to push the liability out? Some factors to consider are fairness, to current partners versus prior partners, accuracy of the adjustment. Excuse me. Okay, so we shall move on. Yep.
All right, we're going to move on to our last polling question because we're running out of time. We want to make sure you guys are getting that CPE credit. So number 4, under the new partnership audit rules, TEFRA's tax matters partner is replaced with A, partnership representative, B, tax matters representative, C, partnership partner, or D, revenue. And you guys have about 40 seconds to answer that. All right, in about 10 seconds left. Okay, and we're closing this one out. Marcus, Tom, what's the correct answer?
It would be partnership representative.
Awesome, 67% of them got it right.
Okay.
So great job, guys.
And since we're on the topic of the partnership representative, let's talk a little bit more about that role now. Okay, Section 6223, as amended by the BBA, provides that the partnerships shall designate a partner or other person with a substantial presence in the United States as the partnership representative, who shall have the sole authority to act on behalf of the partnership. The requirement exists that the IRS provide notice of proceedings to the other partners. So this partnership representative is going to be the only one that the IRS will communicate with. There's no statutory right for partners other than the partnership representative to participate in an audit. And this includes no right to extend the statute of limitations or to change or any adjustments that the IRS makes. And under the code, the term person includes an individual, a trust, a state, a partnership, association, a company, or corporation. There better be a person behind any of these. There's got to be, ultimately, there's got to be a person who bears ultimate responsibility for this, for this role. And the partnership representative, as Tom indicated earlier, is not even required to be a partner in the partnership. And if you do not appoint a partnership representative, the IRS will. You may not like who the IRS chooses, so make sure you appoint and you agree. It's a big decision, as Tom was indicating earlier. So make sure you decide who that person is, and that person's going to need time to determine whether she wants to play this role. Okay. So let's look at oh, good. Yep. Okay, good. So let's go to, is that slide 31?
Yeah.
Okay, let's take a look at slide 31. So the challenges of assuming the role of the partnership representative. Some of the things that, some of the challenges you're going to face if you decide to be a partnership representative is whose interest should the partnership representative be taking into account? The partnership, the partners, and if so, which partner? The one who owns the most, the largest partnership interest? How could the partnership representative possibly adequately take into account what would be best for each partner. And the partnership representative is going to need some serious contractual exculpation and indemnification provisions for the reasons that Tom discussed, earlier. And you may want to have to consider having a group of partners making decisions about what the partnership representative should do in audit, appeals, litigation. The partnership representative should certainly spell out in detail what the partnership representative needs to do in terms of notification, right? The IRS isn't going to notify the partners. So in terms of notifying the partners to let you know what's going on with respect to any examination. And is that it, or do we have?
So the hour is up. If you guys would like to stay on, you're more than welcome to, and Marcus and Tom will talk for about 5 more minutes. And if you guys also have any other questions, or any questions at all, feel free to include them in the chat box. And if we don't have time for Marcus and Tom to answer them live, like I said, we'll shoot you an email with your answers, okay? So Marcus?
Okay, very good. So now let's take a look at some drafting points concerning the partnership representative. Partnership agreements should address selecting, terminating, and replacing the partnership representative. The scope of the partnership representative provision depends on who the partner represents, whether the partnership representative has total authority, board consent, partner consent at some levels. Some key issues to include are notice to the partners, duty to inform the partners, extending the statute of limitations, settling an audit, filing a petition for readjustment, decisions to make to pay tax at the partnership level or to push the liability out. Should partners approve this decision? If so, which partners? Are there de minimis payments that can be made? And obviously the indemnification that you're going to provide to the partnership representative, I can tell you from my experience as an attorney, the part of that indemnification, the less possibly the less responsible of decisions the partnership representative can make if he knows, ultimately he's indemnified. So you have to even be careful with that. There's definitely some trade-offs in that respect. And so next, let's talk a little bit about. Unless you want to answer?
No, go ahead. Why don't you go ahead and finish this up, and then we can just maybe follow up on a few talking points.
Okay. So next, another thing to take into consideration is why a partnership may prefer to pay tax at the entity level. So up to this point, we've given you lots of reasons to push the liability out or to opt out or to do everything you can to avoid paying tax at that partnership level. That's not even a decision that you could make automatically. You have to do some analysis to determine whether that's the best decision for you. So what are some of the factors? The total tax for the reviewed year may be less if you pay it at the partnership tax level. And one example might be, let's say all the partners are at the 39% rate already. Well, there's no section 1411 tax on the with respect to the entity level tax under the BVA. The interest rate, remember, is also lower. If you push the liability out, then the code imposes a 5% increase above the federal short-term rate. So you could get just a 3% over the federal short-term rate if you accept the tax at the entity level. So if you do have that underpayment, the interest that you're going to pay is going to be less, and penalties may actually be less. There may be no substantial understatement at the partnership level, whereas there may be one at the partnership level. And some reasons why you why opting out might be bad, or why accepting the, some more reasons, I guess, why accepting the assessment and collection of tax at the partnership level. Well, audits can become more expansive. The parties will have obligations to have documentation sufficient to support all positions. That's if you're going to try to reduce if you're going to try to reduce the reduce for tax. And there could be implications for tiered partnerships, which is beyond the scope of this conversation and is actually the subject of further regulations. So that's all I have right now. I don't know if you want to add anything, or we certainly have more examples that we can roll through.
Well, the interesting thing about this is this webinar was really not designed to explain changes that were made, which are absolute, you know, like a tax rate going from 39.6% to 35%. It's really just to make sure that the folks out there have an understanding of what's happening here.
Right.
And it's really, if this hasn't been discussed yet within your company, you really have to start having the conversation as to how are you going to address this. It's pretty much mandatory. You really can't bury your head in the sand anymore. And you know, so really, this is just a series of talking points, discussion points, to say, hey, this is what's happening. We don't know what's the best thing for you. You have to decide what's the best thing for you. You have a few options here, and one size, as we mentioned before, one size isn't going to fit all. As it relates to what's the best approach for you.
Right. And it's suffice to say, disharmony will result if partners do not come to some terms with respect to these new partnership audit rules. The IRS will be examining many more partnerships, and you may even see some some companies interested in that can't opt out. Choosing figuring out some other, figure out some other options. But alternatively, you can come to terms with respect to these DBA rules, and they will even be auditing, and they will actually be looking at a lot of returns to determine whether an opt-out election is made. So imagine if you don't address these rules, even at that level, to agree to make the opt-out election. If you don't opt out, the IRS will be looking at it to see if you did make it, if you properly made it. And guess what's going to probably happen if you didn't make the opt-out election? There's a higher probability that you're going to be pulled for an audit.
Yeah, sure.
So at some level, you have to address this. Yeah. And
there's no way to know exactly how many audits are going to occur, what the percentage is going to be. There's no way to know that, but suffice it to say that it will be a greater percentage than what you're currently dealing with right now, which is less than 1%.
Right.
That's absolutely going to go up.
Right.
Because it has to be tested.
Right.
And it needs to be battle tested, and the IRS is going to do that.
Sure. And I would think a measuring stick may be the percentage of similarly situated C corporations. I mean, the drafters of this legislation were guided by the GAO results that pointed up the number of partnership returns, corporation returns that were being audited of the same size of partnership returns that were not being audited. And I would not be surprised if it was not the IRS's objective to bring those things into greater harmony.
Yeah.
So it's going to be quite a few.
Yeah, it is. And probably the next thing, we could talk about this all day, but obviously we don't have the time. But probably another thing to consider, which will likely be the next webinar series that we talk about, which will be the stuff that's happening right now at the federal level. We do have some tax cuts that are hanging out there. We're not exactly sure what's going to happen, but there's a very good chance that something will happen. And once we know what that is, then we're going to be faced with the question of, is it best to be a regular corporation, a partnership, or an S corporation?
Right.
And then you're going to quantify that based on rate structures, and not only the rate structures, but also this.
Absolutely.
These partnership rules.
Right. Right.
Does it make
Another
sense to be a
factor.
partnership now, where maybe you should just be an S corp?
Right.
If the treatment's very similar, or be a C corporation, because you don't have to deal with a lot of this stuff, and if, you know, the bottom line numbers are beneficial or close,
Right.
it's something else that you need to consider. So I think the next webinar that we'll likely have, which will probably be within the next couple of weeks, we'll be talking, and hopefully at that point we have some concrete information as to what's going to happen with the tax cuts. Then circling back to this, I think will be very important, and looking at those two parallel, to not only decide whether you opt in or opt out or push out, but also do you maintain a partnership? I think that's something else that needs to be considered in the future.
No, I agree with him. And no one in the industry can gainsay that. A factor that many partnerships took into consideration was the improbability of being audited. You know, to your point that there's going to be some different decisions that people make in terms of their entity when the new tax law changes become law. If they become law. So when you take that off the table, and now partnerships are being audited at the same rates as other entities, you're going to have to make a comprehensive decision.
That's right. Okay.
Okay, well, thank you everyone for attending our webinar. Please remember to take a moment to complete the online survey when we close out. Have a great day.